Hi, everyone. I'm Doug Alsdorf, the author of Financing Your Future. We made it. It's chapter 16, the conclusion to the entire book. We're going to talk a little bit about decision making and will Social Security still exist? So, will Social Security still exist? Well, the Social Security Administration predicts that their fund will be out of money by the year 2037. And it doesn't look like anybody's too interested in refilling that bucket of money. Instead, they'll still have monies, and it'll be what we call a cash flow gain. So whenever you have a whole bunch of people working then after 2037, they're paying their FICA taxes. And what the Social Security Administration will do is take whoever's working and their FICA taxes, and they'll just hand those to whoever's retired. So it's a cash flow situation. What that really means is that, right now, the Social Security Administration might be paying out 44% to 27% of a college educated person's wage earning salary. But when you retire, because this fund is probably going to get zeroed out, and because they might have to play this cash flow game, they're saying they're going to only be able to award maybe or give out 25% or maybe only 20%, far, far less than what they were doing before. What this means is that an engineer in 4 decades from now, they may have averaged $185,000. And so 20% of that average is $37,000. But that's only $17,000 in today's money or $1,400 a month in today's money. In contrast, a social worker over those next 4 decades, they might average 105,000, and maybe they'll get a little higher percentage. So that's 27,000 they might get, or 12,000 in today's dollars, i.e., $1,000 a month. Trying to get you to understand this is today's money, what you might be able to expect in the future, just to kind of relate to these numbers. These aren't big numbers. They're nice, they're important, but remember, I suggested in retirement you're going to need at least $121,000 or 10,000 per month. In today's dollars, that's like the average college graduate of today at 55,000 or 4,600 per month. In other words, these per month numbers that we see here, they're nice, but they're not at all hitting the mark of what we really need to have in our retirement. So Social Security will probably still exist, but it's just not going to pay very much at all. And therefore, you really want to be working on your own retirement. So start investing now for your future retirement. Short conclusions for each chapter. Hey, chapter one, surround yourself with thoughtful, loving people. Chapter two, people in their 20s and 30s today, they're going to need at least $2 million invested by the time they retire. The average starting salary for somebody today with a college degree, it's about $55,000, average across all majors and average across the US. 4 decades from now, it's probably going to be around 121,000 for an average starting salary for a college graduate. Taxes. Income and FICA taxes are going to remove 20 to 25% of your salary. Loans. Hey, renting's okay. You're not missing out on any great housing opportunity. There's down payment costs when you own a house, loan interest, property taxes, realtor fees, insurance, maintenance. All of these are big expenses when owning. So you're not really missing out by much when you're renting. Childcare. Each child is going to cost you around $1 million. It's about $500,000 in direct costs and about $500,000 because you didn't invest those monies. Chapter 7. Let's not have any fear of missing out. Do not chase the latest investing fad. I would definitely want you to read books. And here again, I'm recommending Malkiel's Random Walk Down Wall Street. There's two ways to make money with stocks: buy low, sell high, reinvest dividends. Individual stocks are too risky for the ordinary investor. And when selecting stocks for a portfolio, it's just not clear if the selections are based on skill or luck. We just can't consistently time the market. Only buy passively managed funds that follow well-known broad market indices such as the S&P 500. Reinvest those dividends too. Control what you can control. I made money by not spending it, by having long-term capital gains taxes, and I avoided fees by investing monies on my own. I control my equity bond investment ratio, and in other words, my asset allocation, and I also control when I want the money. I control my emotions. There's a model we can put forward for seeing how we might be able to hit our investments. Investing $7,000 each year and increasing that by 2% a year, so 7,140 the second year and so on for 40 years. And let's say the investment growth is only 7.5%. for 40 years, that'll make $2 million. That was a model. Measurements. By the time you're 30 years old, if you can have $50,000 invested in a passively managed fund that follows the S&P 500 and reinvest your dividends, in the past, that $50,000 over any 35-year period from 1935 to present would have grown to $2 million, give or take $500,000. Those are measurements of the past. And again, we have no promises of the future at all. Using a growth rate of about 10.5% for the S&P 500. In other words, how important is your 401k contribution from your employer? This is really important. This is kind of the best case kind of scenario at 10.5% a year, but it's only 2,500 that the employer is putting in there into your 401k and assumes that their match will increase 2% a year, and it grows, though the total investment grows at 10.5%. After 35 years, you'd have $900,000 from your employer. Didn't cost you anything. It's their money. They invested it. You guided that investment in your 401k. And because of that, you have 900,000. This 401k is incredibly valuable when you look at your employer's match that comes out of your employer's pocket, not yours. A personal finance advisors typically charge 1%, and over decades of investing, that fee can mount to hundreds of thousands of dollars. Social Security will probably only provide you with a small fraction of your retirement. There's no guarantees about the future. Nobody knows what the financial future will look like. You cannot control the future performance of a stock, nor can you know what that performance will be with any kind of certainty. That is a form of risk. A goal of investing is to reduce risk while maximizing the potential for gains. Speculating, in contrast, ignores the risks while emotionally buying and selling. Note that past gains in the S&P 500. What are we talking about over this, century of timeline that I've been looking at with you in the data? What kind of things happened? Pandemics, the Great Depression, World War II, discovery of DNA, threat of nuclear annihilation, oil crises, computers, growth of the internet. That was fantastic. Medical advances are really amazing what's happening. Collapse of the housing market. Now artificial intelligence. You can't control that future. But a lot of things have happened in the past, and perhaps the future will be even better. Here are some quotes from really well-respected people. You see the references down there, well-respected in finance. This is Burton Malkiel. He's the former dean of the Yale Business School and an author of Random Walk Down Wall Street. He says, and this is from, I think, the preface, if I recall correctly, from his book, investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively manage mutual funds. Malkiel boldly stated that buying and holding all the stocks in a broad market average was likely to outperform professionally managed funds whose high expense fees and high charges and large trading costs detract substantially from the investment returns. And here's John Bogle. He founded Vanguard. They're managing at least $7 trillion. That's incredible. And in his book, he says, yes, the costs of investing matter. So do taxes. Yes, passively managed low-cost stock and bond index funds continue to outperform their actively managed peers. Here's Warren Buffett. We all know who he is. In one of his annual letters to the shareholders of Berkshire Hathaway, he said on page 20 of his 2013 letter, you can find it in his other letters as well, Buffett writes, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term bonds, 90% in very low-cost S&P 500 index funds." He suggests Vanguard's. He goes with a 90-10 equity bond ratio. I'm nothing but a parrot compared to these really, really smart investors. And finally, I'll let you know I'm happy to help. Please feel free to email me. I may suggest that you use my Gmail address. Thank you so much for joining me in this journey looking at your financial future.